This is the 10th installment to the series entitled Build Your Business into an Asset of Value. Being good in business is the most fascinating kind of art. Making money is art, and working is art, and good business is the best art. It is wrong to think that business is only about making profits. More so if you aspire to build a business into an asset of value. Most entrepreneurs think about success in business through the lens of profitability and more specifically income generation. But without profits, an enterprise is no more than a hobby. Financiers are much more interested in good cash flow than profitability. On the other hand, investors view consistent profitability as evidence of the competency of the business's management. The profit and loss statement is akin to the report card of the business and follows very much the same format as the cash flow statement, except for the following key differences. 1. The profit and loss statement reflects transactions concluded within the accounting period, as opposed to the cash flow statement that reflects the actual in- and outflow of cash. 2. The profit and loss statement do not include cash reserves, opening and closing balances. And 3. The profit and loss statement reflects the 4 levels of profitability. Level 1, gross profit. Profits from trading activities. Gross profit equals sales revenue minus cost of sales. Successfully trading its products or services is at the core of what a business is all about and is a function of generating sales and effectively collecting sales revenues and managing cost of sales. At a minimum, a business must be able to generate gross profits of sufficient value to 1. Provide for operating expenses or overheads, and 2. Fund the next round of trading in the cycle. This level of gross profit is sufficient for a hustler, replicator, or pro, but not for a builder aspiring to develop a business into an asset of value. The second level of profitability is operating profits. That is profits after taking operational expenses into account. A business on its way to becoming an asset of value must generate sufficient operating profits to 1. Fund the acquisition of operational and fixed assets, 2. Fund the expansion of trading activities, and 3. Reward shareholders by way of declaring dividends. The third level of profitability is profit before tax. This is not a book about corporate taxation. Suffice to say that it is highly recommended that entrepreneurs engage the services of a suitably qualified accountant or tax practitioner for advice. The fourth level of profitability is net profit after tax. In conclusion, a track record of consistent, growing profitability is testament to the competency of the business's management to deploy capital effectively. Profits only really matter to shareholders when the business uses retained earnings to grow the value of the business. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.